Welcome to TheoTrade. This is Don Kaufman. It's October 21st, 2019, and you are watching the TheoTrade evening video. I'm just seconds after the cash close. The S&Ps are up 17. I gotta say, though, I wouldn't read too deeply into this. The volume inside of the S&P futures, wow, it's just absolutely anemic. And I just want to point this out. If you compare today's volume inside of the S&Ps, and by the way, we're nowhere near even 1 million S&P contracts that have traded. You have to compare this back to, last week, which fell ultimately on a bond holiday. Nevertheless, again, to overemphasize, extraordinarily light trade inside of today's session sees this rally to the upside. And effectively, all we've really done is we've drifted a little higher, off of the 2983 gravity point. Again, for those of you that do follow kind of TheoTrade on a day-to-day or week-to-week basis, 2983 is one of our key gravity points, and you can see that being the low of the day. We drift a little bit higher, but people, we are still stuck in the exact same range that we have been for quite a considerable period of time. To get really specific with you, what I've done here is I've actually zoomed in to a 30-day 1 hour. And the reason I did this is just to overemphasize just the last couple of trading sessions. Well, now we're actually moving on from Friday, then we had a Monday, a Tuesday, a Wednesday, a Thursday, another Friday, and here we are on the Monday. Effectively, we're still in the exact same range, stuck in the middle with you. However, there is a point for me explaining, a little bit of madness, if you will, of this incredibly tight range. And that is, we're seeing a couple products already hit on a Monday the upper edge of the expected move. Now, let me kind of detail a little bit about the expected move as it pertains first to the SPX. The SPX, better known as the mother of all products. All right, the expected move this past week really condensed down quite considerably. By that, I mean, if you look at the previous week's expected move, you're over $50. This week, again, we can kind of contracted in volatility all the way down to the point that this is a $37 expected move. So it's $37 higher or $37 lower. It's something I explained in the weekend video. But, the index products are not the only thing, of course, with expected moves, and some of the other major indices and or sector ETFs do adhere very nicely to the expected moves. One other aspect I want to bring into scope before I actually jump into some of those specific sectors, and more importantly, what I kind of call the fade trade that I think is going to be in play for the remainder of this week. Now, granted, yes, we have earnings coming out. Push that aside for a second because we're going to look at two sectors where there's not going to be a lot in terms of earnings. So again, to just highlight the S&Ps, we're almost halfway home at hitting the upper edge of the expected move. Again, I'll push that aside for a second. The other sector that I've been looking at substantially is none other than the Russell. In fact, with the Russell, I'm going to go ahead and apply what we term auto expected moves. And I want you to see something, again, that's kind of interesting. So here is an index product that on a Monday, already pretty much tagged the upper edge of the expected move and pulled in from it. It's actually what we call a little bit of the fade trade. Now, let me get kind of specific because it's not the Russell. Like the Russell already, and let me actually clear this chart for a second. The Russell, has seemingly already faded to a degree, meaning that the Russell kind of peaked out here at what? 1560 and has kind of faded throughout the course of the day. Well, what has not faded? First of all, let me start inside of the XLF. If you're into, double tops, triple tops, go for it. Listen, I'm not huge into charts. I'm much more into the statistics and the quantitative side of trading. Nevertheless, if you take a look at the XLF actually tagged right and around the 2850 range. It's once, it's twice, maybe the third time's the charm. I could actually care less about that. What I'm actually looking at is the auto expected move. And this auto expected move, what we've actually done in the auto expected move script, is it's taken the expected move from right here in the option chain, and it is actually painted the entire expected move for that week directly onto the chart. And what I wanted to show you that I call, AKA the fade trade, we actually did tag, again, the upper edge of the expected move, specifically here to the XLF, and we're just off of it now at the cash close. This could be a great setup for a fade trade. Listen, because there's a line on your screen, I want to make this just abundantly clear, because there's a line on your screen, that doesn't mean that the product, the XLF, can't cross simply above it. All I'm saying in here, okay, is there is a decent high probability that we actually fade somewhat on this week. Now, one of the reasons that I like picking the XLF is this is like really one of your strongest sectors in the entire trading session. In fact, let's open that up. And you can see that the XLF is even outpacing the monsters of tech. It's up about 1.4%. And that 1.4% tagged the edge of the expected move. Okay, again, there's no earnings heavily inside of the financials. For the most part, most of that has already, okay, kind of come and gone, right? Most of the financials were through earnings. I believe this is going to be a decent fade trade. How would you take advantage of a fade trade? This is where I would actually go in and use, again, very short duration. Again, very short duration type spreads. Could you do it for 4 days? You could even do it for 3 days. Very short duration, okay, small spreads in here, or even go out, for instance, like 11 days. If you're not scared of a little bit more risk, you could even use a slightly in the money put, okay, and just carry a slightly in the money put. By the way, a slightly in the money put is the what? It's a synthetic equivalent for short stock that could actually help you in terms of a fade trade. The other thing is, and I'll just give you an example here, like these 29.50 puts, okay, you went out, if you bought those for about $1, well, the most you can possibly lose is $1 on them. And you can see I'm carrying positions here in the 29 puts. They're trading for about 53 to 54 cents. They give you about an 86 delta. It's not half bad to take a little bit of a short position, okay, for the remainder of a 4-day trading week. Again, it's kind of a fade trade. The other product that is in play for this is none other than the XLE. Now, the XLE, what is it? It's the energy sector, okay? And not to confuse anybody, but I already have a number of positions that are working specifically inside of the XLE, but the XLE also, it tagged the edge of the expected move. Again, you could not have drawn this, okay, any more effective than it already was on this chart. But when I say we tag the upper edge of the expected move, I mean, that's it, people. Pretty much the closing price is the edge of the expected move. I have anticipation that throughout the remainder of the week, yeah, we might cross a little bit above this, but then, of course, fade back, okay, to the downside. Now, as I said, I've already got a couple of positions inside the XLE. One of those happens to be a bullish position. Now, my bullish position, and I want to just clarify this, I paid about $1 for a spread. The spread that I paid $1 for is about $1.30 right now. I'm actually getting very close, okay, to the closing of my bullish bias inside of the XLE. Yet there's one other position that I also have inside of the XLE, and that happens to be a big time ratio back spread, but that one's all the way out in January. This is a bullish position all the way out in the January time frame. Okay, again, even though I've got a couple of positions that are a bit further out in time, I'm still looking, again, for the XLE to possibly continue this rally and then fade as the week kind of progresses. This is a trade that, you know what, we haven't talked about, okay, too much substance in quite some time. But this fade trade, it's in play, and it's in play right now because we're trading, right, on the S&Ps, well, relatively sideways. I mean, the S&Ps over the last 7 trading sessions, for the most part, net, when I say 7 trading sessions, yeah, they are massively unchanged. I mean, there's no doubt we're at the upper edge of the range for the last trading days, okay? But it's still, for the most part, massively unchanged. And we're not seeing great degrees of correlation. That is, when you start looking at things like the S&P 100, and I like to bring this up from time to time, come down here to the S&P 100, the advanced decline line, yeah, it's 74.25. It's still a veritable slop fest. So I'd start to get very sector specific. And in this particular case, I'm actually trying to circumnavigate some of the earnings. There's no question I'm going to have lots of earnings trades as this week progresses. Nevertheless, okay, for the time being, look for the fade trade to play out both in the financials and in the energy sector. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.